Hello trade pros and welcome to today's video. Today we're going to talk about a seasonal stock market effect called portfolio rebalancing and how institutional investors and money managers use portfolio rebalancing to satisfy the objective of their fund. And more importantly, we're going to talk about what this means for you as a trader and how you could take advantage. Let's dive right into this video. So before we begin diving into this concept, let's talk about when this occurs. The times you want to watch this for in particular are at the end of every month, at the end of every quarter, and the most aggressive portfolio rebalancing happens at the end of every year. So towards the end of December is when this effect is at its strongest. Let's talk about what causes portfolio rebalancing. But before we get into that concept, let's talk about something in a general term. Asset allocation. You might have also heard this referred to as an asset mix. As a portfolio manager, you create a mandate and an investment objective that you then sell the idea to investors. Investors purchase units in your funds, and now you have to go out there and execute that investment objective exactly like you planned it. An asset mix is referred to the composure of the portfolio funds. In the last few decades, the balanced fund has gained the most popularity, and there's been a lot of money that's been invested from pension funds, endowment funds, insurance companies, and a lot of other institutional categories. This balanced fund that is comprised of 60% equity and 40% fixed income is a favorite in the portfolio management space for decades, and it continues to be today. So now as a portfolio manager that you've sold your investors on the idea of having 60% exposure to equity and 40% to fixed income, it's your job to go on the market and execute that investment policy. Now, let's have a look at that 60-40. Let's assume you start out today with $100 million of cash from all of your investors. These are pension funds, like we mentioned, insurance companies, accredited investors. Everyone pools that money together into a fund. You're starting with $100 million. That means $60 million is invested in equities and $40 million is invested in fixed income products. You then go in and diversify each category. So you won't buy one stock with it. You're not going to go long Apple with $60 million, but you will break that down to a diversified asset mix in your equity portfolio, and then you'll find different maturities and duration bonds to create a bond portfolio. 60 million equity, 40 million bonds. You're now invested, and you tell your clients, we're fully in the market. From here, let the market do its job. But now we get close to the end of the year, and the markets have rallied, let's assume 10% in the equity space. Bonds haven't moved. Let's use this as a simple example. That means that the 10% growth in your equity portfolio is now at 66 million. That's the 60 million of your initial balance plus the 6 million unrealized gains that you currently hold. Assuming that your bond portfolio is at 40 million and hasn't moved, you now have a problem because what you sold to your investors is no longer the case. You're overinvested in equities and underinvested in bonds. So now your equity portfolio, once again, is worth 66 million. Bonds are at 40. Your total portfolio is worth 106 million. However, if you were to divide 40% off of 106, you'll notice that you should be at 63.6 million of equities and the rest in bonds. This means that you need to sell your equity piece of the pie and put that money into bonds to return to the asset mix. This generates a 2.7 million notional value that you have to sell on the equity market and purchase the equivalent in bonds. So at the end of the year, when you send your clients the statement, it shows the holdings and they match the investment policy and asset mix that you promised them. This effect is called portfolio rebalancing. In short, it's selling the assets that have had gains and buying the ones that haven't to return the balance back into the mandate of your portfolio. Now, most investors check their statements on a quarterly and annual basis. So on the annual basis, it's the most important one with the most amount of scrutiny because these are your year-end numbers and they go into your historical track record. So what opportunity does this provide for us as traders and investors? When you're approaching a month end, you really need to look at the past month and ask yourself, have bonds or equities performed evenly? Has one outperformed the other? And how and what would need to happen in order for that transaction to balance back out? In a month where you're seeing a gain of 6% on equities with 6% on bonds, you're closer to your diversified portfolio allocation. However, if you have an outstripped gain in the equity markets and bonds haven't performed as much, the portfolio rebalancing effect becomes more drastic. So it's your job as a trader to keep tabs on market performance. You need just two charts, stocks and fixed income. You could use S&P 500 for the stocks, and you could use the ZB future symbol, which is the 30-year bond rate, and also use the 10-year bond rate. However, these aren't permanent or exact because the actual composition of the portfolio would likely be different than these two indices, but it's a rough way to approximate it. Whenever you have an out of balance move, you know there's gonna be some portfolio rebalancing towards the end of the month. As we approach the end of this year in 2020, equities have significantly recovered from their pandemic lows, and we're close to all-time highs as recording date of this video. So we are expecting to see some portfolio rebalancing into year end that leads to selling of equities and a bid up into bonds for investment managers to bring their asset mixes back into the range of what was promised to the investor. But when does this happen? Is there one date you should expect for this trade to carry itself out? The answer is no. Portfolio managers have the ability to do it throughout the month at any time. But what's important to know is there's a calculated $350 billion plus of selling of equities to bring portfolios in alignment that are invested in the US stock market. So this is going to be an interesting end to the year and something to watch out for as we head to the end of December. If all portfolio managers were to allocate and remix their portfolios on one day, they would get really bad fills and it would act against them. So there are a lot of tools and techniques used to hide this order flow activity. But at the end of the day, a seller with quantity is a seller that's going to come through the market. Watch out for this trend and keep this in mind for your analysis. And remember, this is an occurrence every month, end of quarter, and the strongest effect being at the end of the year. And you now know how the portfolio balancing effect works, how to utilize it as part of your strategy and analysis, and to expect it on an annual basis. If you like this video, please click the like button and hit subscribe. And be sure to hit the notifications bell so you're alerted when we have new videos coming out. That's it for today, and I'm excited to share a lot more great content with you. See you guys at the next video, and remember, manage that risk and trade like a trade pro. Take care and goodbye.